near term, our models are generating a pretty mixed bag of messages, lots of different signals, and they're not giving a very clear steer on likely equity market direction for the next few days and weeks. So we're sort of standing back and watching and waiting a little bit for now in the very near term. But I think the longer term, we've had a very bearish stance. We still have that. We are underweight US and global equities. We're underweight high yield credit. We're overweight treasuries, overweight high grade credit. We just established an overweight position in high grade at the back end of last year. And, the theme I think that we've been thinking about, talking about to clients is this idea that markets will transition from chapter 1 of the bear market, which was really last year, to chapter 2. And chapter 1 last year really was a major taper tantrum in markets. It was all driven by fears about high inflation and high rates and Fed tightening. And we had all the characteristics of a taper tantrum. We had a backup in real yields. We had a fall in the equity risk premium because the earnings yield went up, but real yields went up more. So the equity market actually became more expensive last year on an equity risk premium basis. And then we've had this pretty rapid switch in the bond equity correlation into positive territory last year. That happened in fact, all of that happened in the last taper tantrum in 2013. So I think that's what's been characterizing and defining last year. This year, we think it's all about chapter 2. The bear market drivers change is really what we're saying. And it's a market that increasingly sort of focuses on and prices in a US and global recession and a contraction in earnings, neither of which have really been priced by markets. So I think that's what markets really focus on and price in this year. And that's what's different compared to last year.
Yeah. Continuing on that theme, I'm also a bit concerned about the outlook for earnings. I mean, it looks like the consensus, if we stick with the S&P consensus, is still for, like 5% earnings growth in 2023. Yeah. So that obviously needs to be revised, probably.
Well, exactly. And I think that's what this is what will become the main sort of focus of markets this year, is that, earnings need to shrink. And typically, by the way, recession-related bear markets don't finish until forward earnings have stopped shrinking. So, and the market, earnings start stabilizing and turning higher, and that's when the equity market stops going down. You also typically need to see a Fed that is pretty advanced in its easing cycle, and there are lots of ways of measuring that. One of them is a very sharp bull steepening of the yield curve, which typically happens, a lot of which happens before recession even begins. So look, I think we need to see earnings shrink. We need to see the Fed embark on an easing cycle. We need to see the equity market much lower, much cheaper. We need real yields that are basically close to zero. We need a higher equity risk premium. We need all these things. We need to see all these things before we can be confident that markets have properly priced recession.
And when it comes to earnings downgrades, that is probably going to take place here when we get the Q4 results and outlook for 2023 will be one such event. But when it comes to Fed easing, how would you expect the path for that in 2023?
Well, I think they're not going to start easing anytime soon. And at the moment, they're talking about, raising rates more, and their language is very hawkish. And it's like turning a big tanker. They need to do 180-degree switch on policy. And for the Fed, that always takes quite a long time. And it may take a little bit longer this time because inflation's high. Now, I think what we'll start to see in the first half of this year are growing signs of recession in the US, and a number of other downside surprises on inflation. We've already had a few, but I think we'll get a few more. And all of that, I think, will lead the Fed to begin to turn the tanker, if you like, such that by the second half of the year, they're really thinking about easing policy if they haven't already started with some baby steps towards loosening up. So, look, I think these things take time for the Fed. But I suspect we're going to see a marked change in their policy stance over the course of the next 6-9 months.
Yeah. Okay. So to me, this sounds a little bit like we could have a V-shaped market development for this year, with the continued weakness in the first half, and then around mid-year, maybe market starts to price in this easing scenario, and sort of from here to 12 months ahead, it could still be, a fairly balanced development, but with this V-shape.
Yeah, it depends on the timing of when recession starts,
Mm.
how long will it be, how deep will the recession be, and also how quickly does inflation fall. If inflation's a little stickier than we think, then the Fed are going to be a little bit slower to respond and try to ease. And the other thing to remember is that typically you want to see the Fed pretty advanced in an easing cycle before you see the low in equities. And I'm not sure we're going to get anywhere near advanced in an easing cycle out of the Fed this year. So look, I mean, do we see the low in the middle of this year? I mean, it's perfectly plausible. We could be halfway through the recession. Maybe it's the second half of the year, it's Q3 or maybe Q4. It's very difficult to precisely map these things out at the start of the year. You sort of set yourself up for being wrong when you do that. But it's broadly, you're broadly speaking, I think the interesting observation is that there's more downside to come in the S&P. The other way to think about it, rather than trying to pick the exact timing, the other way to think about it is the level. And if you get a 10-year real yield that goes back to zero, if you've got an equity risk premium that needs to go to, say, 5, 6, maybe 7%, and earnings are going to shrink by, let's say, 20% from their highs, then all of that, those ingredients, if you put them together, tell you that the S&P really needs to be getting down to more like 3,000 in order to price recession and to reflect that equity risk premium and that level of real yields and the earnings contraction. So look, 3,000, I would say, if we got to those kind of levels and all those other ducks were lined up, then we're talking about a market that is, broadly speaking, priced in the US recession and earnings contraction. So I think that's another way to think about it, as well as timing.
Yeah, that's quite a negative scenario, Harry.
Yeah, it's very bearish, for sure.
Yeah, pretty bearish. Yeah, well, we'll continue to monitor this and speak to you and try to navigate this difficult market. Thank you very much, Harry.
Excellent. Thanks, Stefan. Great stuff.